Ouma, and I'll be taking you in this unit. My contacts are, the phone number is 0780 404 324, and my email address is barak.ouma@zetech.ac.ke. So those are my contacts. You can reach me on them. For this lesson today, this is our lesson 1, current liabilities. And the objective of this lesson is that we as learners are able to define a liability and also being able to specify its characteristics. So we should be able to define a liability and also to specify the characteristics of a liability. The second objective is that we should be able also to distinguish between the short-term and long-term liabilities. I know you have learned about liabilities before, and both the current and the long-term. So that is one of our objectives also in accounting for equities and liabilities. The third objective is that we should also be able to record transactions that involves liabilities as the short-term notes payable, the product warranty, and even the unearned revenues. And then lastly, we should be able to also understand the accounting for interest-bearing and non-interest-bearing current liabilities. So I want us to start by defining a liability. So we may define a liability in two ways. One is that liabilities represent obligations that require future payment of assets or performance of services, and the Financial Accounting Standard Board has also defined liabilities as probable future sacrifices of economic benefits that arise from present obligations of a particular entity to transfer assets or provide services. So simply a liability is just there. We can simply say that it is just a debt. We can say that it is just a debt. That is what liability simply means. So if we look at the characteristics of liability or the features, one is that a liability represents a duty of one entity to settle by transfer of assets or provision of services in future. So what you owe someone, you should be able to settle it in future. Then the second characteristic is that it is unavoidable obligation. Unavoidable, it means that it is something that is not, we are not able to avoid it in the present state. And then the third characteristic is that the transaction or the event creating the obligation has already occurred. So you have already occurred the transaction. You have already occurred the transaction. So those are the three characteristics of liabilities. The other item is now to define a current liability. A current liability is also referred to as the short-term liability. So I'm just going through them very fast because I know you have already encountered them. Now, the American Institute of Certified Public Accountants define the current liabilities as obligations whose liquidation is reasonably expected to require the use of existing resources properly, and their the resources may be classified as the current assets or the creation of current liabilities. So in short, they are liabilities that are expected to be paid over a short period of time, maybe the short-term loans, and the short period of time may be for a period of not more than 60 days, not more than 60 days. Then we have the types of current liabilities, and the first type is accounts payable. Accounts payable. Now, accounts payable are what we usually commonly refer to as creditors. Creditors. So that is what uh, we refer to as the accounts payable. Now, the accounts payable, they are also referred in some books as traded accounts payable, and they usually arise when an entity purchases goods, supplies, or services in the normal course of business, and there is a time lag between the time of purchase and the time of payment. So you are allowed to pay for the items at a later date. So for example, we can assume that there is a gross purchase of 100,000 shillings of 2 out of 100 net. So to get the net purchase now, we will take the other remaining percentage. If you subtract 2 from 100, what remains is 98. So we'll have 98 out of 100 times 100,000, and that will give us a net purchase of 98,000. That gives us a net purchase of 98,000. So to record this, because we are buying the items, the accounts that will be affected are: one, we have the accounts payable, and then two, we have the inventory, because we are buying the we are assuming that we are buying the stock or the inventory. So the inventory, because you are acquiring the inventory, and the inventory is an asset, an increase in an asset is always debited. So you debit the inventory by the amount, which is 98,000, and at the same time you credit the liability, which is now the accounts payable, by 98,000. Now, as you all know, an increase in liability is always credited, because liabilities have a credit normal balance. So any increase is credited, any decrease is debited. We move on to our next slide. Then we have number B, we have the short-term or the current notes payable. Now it is not accounts payable, it is notes payable, the current notes payable. Now the notes payable are simply the written promises to pay a certain sum of money on a specified future date, and they may arise from sales, financing, or other transactions. So again, for the notes, we have different types of notes. The first one is the trade notes payable. The trade notes payable. Now, for the trade notes payable, it is simply a note that is given to secure a time extension on an account. So we can say that they are the notes payable current obligations to supplies for which they are written promissory notes. And I believe that you all know what a promissory note is. Now, the trade notes payable arise when the terms of payment include a longer payment period than is normal for trade accounts payable. So the only difference between the trade notes payable and the accounts payable is the time period that you are expected to pay for your notes or for your debt. Now, for an illustration, assume that Hard Rock Company cannot pay its past due, which is 600,000 shillings, with the Apex Company. Now, as an accommodation, Apex Company agrees to accept Hard Rock Company's 60-day 12% for the amount, not in granting an extension on the due date of the debt on August 23rd, 2000. Now, for this case, now to record the issuance of the note, for example, to record the issuance of the note, we will debit the accounts payable. Now, the accounts payable in our case is now the Apex Company, which we debit by 600,000, and then we credit the notes payable. We credit the notes payable by 600,000, just to recognize the existence of that note without incorporating the interest and even the time period. So that is how we record that transaction. So to recognize that note, the 600,000, we debit the accounts payable, which is now the Apex Company, and then now we credit the notes payable with the same amount. Then we should also note that the note does not pay off the debt. Rather, the form of the debt merely changed from accounts payable to the notes payable. And we have said that by changing that, what we are doing is that we are just extending the debt period. So we are also advised the Apex Company should prefer holding the note to the account, because in case of default, the note is a very good written evidence of the debt's existence and its amount. So the note shows that the Hard Rock Company really owes the Apex Company. Now, when the note becomes due, that is when now the Apex Company will be supposed to pay. Then the transaction entries that we'll make is that, number one, you'll have to calculate the interest. And remember the interest is 12%. So first of all, you calculate the 12% of 600,000. 12% of 600,000. So if you get that, then that will be 12% of 600,000. And then period here is October, so you be in cognizant of the time period. Remember, the note was taken on 23rd of August, and it is for 60 days. 60 days. Percent is per annum. Per annum. 12% is per annum. So a year has got. So between August and October, we have 2 months. So we have August to September, that is 1 month. September to October, those are 2 months. So the interest that will be paid will not be 12% because the 12% is for the interest for a whole year. So if we are talking about 2 months, then now the interest for 2 months, if 12% is charged for a whole year, it means that on a monthly basis, now what Apex company is charging on the note is 1% for every month, 1%. Now that between August we have 2 months, so the interest that will be payable will be 2%. So 2 out of 100 times 600,000, and therefore the interest expense will now be 12,000. So the hard rock company will now pay the note, which is 600,000 plus the 200,000. This is account of now the hard rock. So we debit the notes payable and the interest, and then we credit the cash. So to signify the note that is paid with an interest. So that is how we go about that. First of all, we recognize the existence of the note, and then when the note becomes due, we also make an accounting entry. Now, the other item is borrowing from a bank or loan companies. Borrowing from or loan companies. Now, when lending money, banks or loan companies, they typically require that a borrower sign a promissory note. Sometimes the note states the signer of the note, it states that the signer of the note promises to pay the principal plus interest. Now, the note that the borrowers of bank loans do usually sign is what we call in our account offer letter. The offer letter it is simply a promissory note because you are accepting the offer and you are also accepting the terms. You are accepting the offer and you are also accepting the terms of the offer. Now we continue with the borrowing from the banks. Our next item is the interest-bearing note issued. Now, the interest-bearing notes specify a rate of interest. Now, the debtor will receive the cash or other assets and will pay back the face amount of the note plus the interest at the stated rate on one or more interest dates. So it will now depend on the borrower and the lender on the terms of the interest bearing. So for an example, Githurai National Bank agrees to lend 100,000 shillings on March 1st, 2019 to Rocky Company. Rocky Company signs 100,000, 12% 4-month note, 12% 4-month note, and then we are told to record the entries in Rocky Company account. Now remember the loan here or the note here is 100,000, and then it is to run from March 1st, and for a period of 4 months. So maybe we can look at that. Now, to recognize the receipt of the 100,000, we need to make the following journal entry. So for that March 1st, first of all, Rocky Company will receive cash of the 100,000, and there is also a notes payable account. So this transaction is affecting two accounts. One is the cash account. Now the cash will increase, and remember, cash is an asset, and all assets have got a debit normal balance. So any increase is debited, and any decrease is credited. So we will debit the cash account with the 100,000, and then the other account that is affected is the notes payable. The notes payable, now the loan itself. So because it is a loan, and a loan or a notes are having a normal credit balances. So any increase is credited. So we record that to record the issuance of the 12% 4-month note to Rocky Company. So that is how we recognize the issuance of the note. Now, when the note now becomes due or for payment, remember it is a 4-month note, and the interest is always charged on a yearly basis. The interest is charged on a yearly basis. So to know the interest expense after the 4-month period, we will take the 12%, that is the interest for a year, then we multiply by the percentage of the 4 months. Remember, a year has got 12 months. So we'll multiply 12 over 100 times 4 out of 12, then times the amount of the note, which is 100,000. So if you do that, then we'll have 100,000 times 12 times 4 out of 12. The interest expense will be 4,000 shillings. So if you multiply this, the 12% times 1,000 is 12,000. So if you multiply 12,000 by 4 out of 12, 12 will cancel with 12, and then we'll have 4,000 as the interest expense. So again, for the interest that is accrued, the entry to make is that we debit the interest expense account and we credit the interest payable account. We debit the interest expense account and we credit the interest payable account with the same amount. Now, when the note becomes due at maturity now in July, because now it was for a 4-month period, now we will debit the notes payable, the interest payable, and we credit cash. Remember, Rocky Company is paying cash. Cash has got a debit normal balance. So any decrease is credited. Any decrease is credited. And that is to just record the payment to Githurai National Bank. So that is how we deal with the interest bearing notes. Interest bearing notes. I hope we are together. Next, we move to non-interest bearing note or zero interest bearing notes. Now, the label non-interest bearing is misleading because the interest that the notes that we are talking about, they actually bear an interest. What is always done is that there is always a discount on the notes. That's why we refer to them as zero interest. You are given a note and then you're also given a discount. So to illustrate that, we assume that on December 11, 2017, XYZ Limited discounts at 15% on its own 6,000 shillings 60-day non-interest bearing note payable. Now we are told to prepare the accounts to the transaction. Remember, we are told that the discount is at 15%. So it is the 15% of the 6,000 shillings. So we can look at the solution. Now for the 60-day, again, we assume a year has got 360 days. So to calculate the discount, we'll just have the amount on the note, which is 6,000. Then we multiply this by 15%, 15 over 100, times 60 over 360. So we are assuming that a year has got 360 days. You can also approach it maybe differently by using the month. That 60 days is equivalent to 2 months. So we can have 6,000 times 15% now times 2 out of 12, because a year has got 12 months. So if you do that with your calculator, you just multiply 6,000, then times 15 over 100 times now 2 out of 12. You will get the same 150. So that is the discount that is payable on the note. So to recognize the presence of that note, now on December 11th, we will now have the cash, the difference. Now the 150, you subtract the 150 from the 6,000 shillings. That will be 5,850. And then you also debit the discounts on notes payable, which is again 150. And then you will credit the notes payable. You will credit the notes payable, which is 6,000, the total amount. Remember, the 150 is just a discount. Now, when the note matures, now XYZ Limited is required to pay the full face amount of the note, which is now 6,000. You will be required to pay the 6,000. So therefore, this entry will be recorded as follows. One, we will debit the notes payable, which is 6,000, and also you will just pay the total amount, which is cash 6,000. So we credit cash because cash has got a debit normal balance. So remember, XYZ is paying, so they are taking the money from their account now to pay to pay the loan. So it means that now their cash will be decreasing. Our next item will be the unearned revenues. So this is maybe a revenue that a payment that has been made, assuming that you are selling items, then somebody comes to you, give you an amount, but you have not supplied for the goods or the services. So that is what we refer to as an unearned revenue. So it is simply the cash collected in advance of the delivery of a good or service, and it creates a liability. If somebody comes and pays you maybe a given amount of money and you have not supplied for the items, it means that you have his or her debt. So, for example, we can talk of the revenues that are collected in advance, like the college tuition. You can pay your next semester fee. So, ZTEC will record that as an earned revenue because you have not started that semester. Then maybe rent, ticket sales, magazine subscriptions, and many others. So that will be considered as an earned revenue. Now, when the product service is delivered, then the revenue will now be earned and the liability account will be decreased and appropriate revenue account credited. So when you run it, when you earn it, so you will decrease the the liability account. Remember, uh, liabilities have got credit normal balances. They have got credit normal balances. So decrease will be any decrease will be debited. Any increase is credited. Now to illustrate that, assume that ZTEC University sells 10,000 season football tickets at 50 shillings each for its 5-game home schedule. Now, for the 5 games, each person will pay 50, and the number of people who have paid for these tickets are 10,000. So it means that the total sales now that they would have received 10,000 times 50. So if you multiply 10,000 by 50, we'll have 500,000. So now to recognize the unearned revenue, from the sales, we will debit cash because they have received the cash. So cash we debit with the product of 10,050. So that is 500,000. Then we credit the unearned football ticket revenue, which is the same amount again, 500,000. And this is simply to record the sale of the 10,000 season tickets. So any question up to that point, you can unmute your microphones. Any questions so far? Yes, Said. Any question? Any question? Okay, if there is no question, then we can continue. Now, as each game is completed, the following entry is made. Now, remember the 50 shillings was for 5 games. Now, to get the cost of each game, now we'll divide 50 by 5. So that gives us 10. So uh, for each game, we'll have 50 divided by 5. So that will be 10. That gives us 10. So remember, we have 10,000. Remember, we have 10,000 uh, fans who will be watching the games. So the 10,000 fans who will be watching the games times the amount that is charged on each game, which is 10 shillings, that will be 10 shillings times 10,000. So the revenue, the revenue for each game will be 10 times 10,000, which is 100,000 shillings. So what we'll do, the entry that we will make in such a case, now we will debit the unearned football ticket revenue. We debit the unearned football ticket revenue with 100,000. Remember how we have got the 100,000? We have divided the 50 shillings for the 5 games. Remember, we have 1 game. So to get the cost of 1 game, you divide 50 by 5, and that gives us a 10. That gives us a 10. So 10 shillings for each game. And then we have 10,000 funds. So 10 shillings times 10,000 gives us 100,000 shillings. Now, so we debit the unearned football ticket revenue, we debit 100,000, and then the football ticket revenue, 100,000. So this is now to recognize or to record the football ticket revenue earned. To record the football ticket revenue earned. So that is how we go about the unearned revenue. So first of all, you must record the entries for the sale of the total unearned revenues, and then now as you now complete, as you now supply the goods to your customers, or as you now meet the service, as you now meet the service of your customers, you'll now be recording each completed revenue in each case. Uh, Next is the dividends payable. Now, dividend is just an some part of profit that money. I was saying that now a dividend is just part of the profit that an organization may decide to share with their shareholders, and it is always payable is simply an amount owed by corporation to its organization. So we have said that. Now, at the date of declaration, the corporation as that places the stockholders in the position of creditors in the amount of dividends declared. So they are always classified as current liabilities because they are short term. They have the property taxes payable. So for the property taxes, they are always based on the assessed government. So in Kenya, we have the county. Now, in this case, we can use for accounting for properties taxes, and both of the procedures recognize that the property tax expense over the fiscal year or the financial year now. When are you recording the liability? Be at the date at which the taxes are assessed, or is it at the end of the fiscal year? Now, the recognition of the entire tax liability on the lien debt, which typically precedes the payment date, results in recording a debt to deferred property tax expense. Now, what we mean by the lien date is that it is the date or the time when the taxes for the fiscal year becomes a lien on the property. The lien date can also be a date of the valuation of the property. It is a date of the valuation of the property. So the date at which that property is valued, that is what we call the lien date. Now, I would want us now to go to our discussion forum and perform a brief operation there. So the way you joined